Hey everybody, this is Jose Blasco. This is a sound check. We are about to get started in just a few seconds. Please go ahead and confirm that you hear me well. That way I will know sound is good. I believe that's the case. So thank you, Mark. How are you, my friend? Happy Boxing Day. Good to see you all, everybody. So let's get started. Let me turn on the video stream. Here we go. Hello, everyone, from my usual bottom right corner of the screen. Welcome to the session today. Today it is December 26, 2021, and this is a top session. So a pleasure for me, Jose Blasco, to be your guide today in the session. Before we get started, I will highlight the disclaimer. As always, please read it carefully. This is important information. It's fairly short, so please do not skip it. Read it completely. I am counting on that. Joe, how are you, Joe? Good to see you. And with the disclaimer out of the way, again, quick reminder of the structure of the session, the agenda. We're going to be looking at top. We're going to be learning more features. Often, it is not possible to talk about trading software without talking about trading, and therefore our session become a little bit of a mix between the use of the software, but also lectures related to trading. Which ideally makes those sessions very interesting to you guys, apart from the software and beyond the software. So enjoy and feel free to ask questions at any moment. Happy to listen carefully and go over those materials with you guys. So with all of this said, there is only one thing left before we get started, which is to remind you of our page, tradewithufos.com/Jose. So if you have any question, for sure you can contact us in all different ways possible through our website, email, etc. But ideally, you would use this question page where you would log in, and once you log in, you can then click on the green button, ask a question, and this is where you would post your questions and you would get your answers. Before you do that, recommended here to search for questions, because your questions may have already answers from prior times where other traders, other members of our community ask about the same thing you are looking to clarify, and therefore your answers may be waiting for you already before you even post them. So make sure you use this page, as I believe it's quite useful for you all. Thank you for that. And with all of this said, we are now looking at the platform and ready to continue where we left. Mark, for your interest, my risk graph doesn't plot either, and the subtotals don't show on the positions in top 2 now. Okay, I'm not fully sure I fully understand what you mean by that. In any case, let me go over the lecture I have planned for today, Mark, so we can keep some structured approach to our session. And what would be very useful is if you could maybe take a screenshot. Let me go ahead and share with you 1 second. I will share on the chat box an application that could be very useful. Here we go. So I'm just pasting it on the chat box. Okay, here we go. So if you could go ahead and take a screenshot of what you are referring to, use the link I just pasted on the chat box, okay, and that will allow you to basically create a link that then you would paste on the chat box, and then I will get to see your screen, okay? So please do that so I understand better what you mean, because I'm not fully sure I follow, okay? And if you have any problem with the installation of top, so we can also talk about that. You can repair the installation, you can reinstall. That's fairly easy. I can lead you to do that, but ideally, before we do all of that, I'd get to see your screen so I would understand the problem better, okay? No need for an email since we are connected live. I mean, if you prefer an email, Mark, no problem. But since we are connected live, you can use that link I just shared for you to generate those screenshots and share directly in the chat box so I can see, okay? If you prefer email, not a problem. Anyway, so let's begin, okay? And what we have been doing for a few sessions now, we've been going over studies. We looked at all the studies on the top that were studies that work as an overlay, for example, the UFOs. And in the prior session, we started with the studies in the bottom part of this list, which are the studies that are plotted as a subgraph, such as AutoClimate, okay? In the last session, we went over AutoClimate and accumulation distribution. which also got me talking about on-balance volume. Today we're going to continue with ADX and DMI, and we'll continue going down, the list from that sequence. Okay, so for this to be well understood and simplified, I'm just going to open a fresh chart with nothing on it. So I'm going to remove all studies, and we have just a blank chart here with nothing. And what I'm going to do, since we're going to be talking about the ADX, so I'm right-clicking on the chart, selecting Add Study, and I'm looking for Average Directional Movement, which is ADX, and I'm just going to click on it. So as always, the moment you click on it, you will get this window that is asking for a series of parameters that some of them are by default. Mark, I'm just looking at your message. It's you're not bothering at all. Okay, I'm just trying to be efficient on helping you, and on top of that, I owe you some emails. It's been quite saturated, and obviously in the recent times with Christmas, I've not been the most efficient of all. Okay, but again, we can certainly use today's time if you are comfortable with that. No problem. So as I was saying, I just clicked on ADX. It's bringing me to that window with parameters. I'll discuss that in a moment. For now, I'm just going to click OK. And the moment I click OK, I got my subgraph study plotted. Okay, just like any other subgraph study. Okay, so now how do you deal with this? Okay, well, as always, you can right click on the subgraph and go for properties. Okay, or you can just double click on the header if you wish, double click on it, and this will bring the properties without having you right click and select properties, which is 2 steps. So you can just do it in 1 step. So what is ADX and what are those options? Okay, what are those options? Okay, so crash course on ADX/DMI. Okay, so what ADX-DMI does is it's first looking at DMI, which is the Directional Movement Index, and out of the Directional Movement Index, then the ADX is calculated. Okay, so what is DMI and what is ADX? Well, DMI is an index that basically calculates how strong the pushes to the upside are. Okay, pushes to the upside may not be a technical term, but I guess you are with me on what I mean. And the directional index, the minus DI, which is the directional index pointing down, is calculating how strong the pushes to the downside are. Okay, now what is a push to the upside? What is a push to the downside? Well, this basically you are looking, and I'm going to oversimplify the process here because, again, this is not a technical analysis course, right? But basically you are looking at the high of the current candle, and then you are looking at the high of the next candle, okay? And you calculate the distance from high to high, and then you are also looking at the low of the current candle, and then you look at the low of the next candle, okay? And then you're going to be calculating the distance, okay? And when you calculate at those distances going down, those distances going up, so you basically get to understand how strong the market is pushing up and how strong the market is pushing down. And then you kind of normalize all of these using an ATR, an average true range, which is an indicator that is probably already known by you, which we'll talk about it in a moment because I think is the next one in the list. But basically, you are kind of normalizing the strength to the upside versus the strength to the downside, creating that plus DI and minus DI, which again represents a directional index up or directional index down. It's a bit more complex than that, but I guess this does, this explanation does a good job of having you understand what does it mean, to look for those strength of the pushes to the upside, or strength for the pushes to the downside, okay? And once you have calculated all of this, okay, and you get to see, in my case, the red and the green lines, okay, which, by the way, you could disable the plotting of ADX, which I haven't explained yet, which is the blue line. So let's do that for now. So now you only have the green and the red, being the green, the plus DI line, which is the pushes to the upside, and the minus DI line, the red one, which is the pushes to the downside. So now you can see, for example, in the current moment, that the pushes to the upside surpass the strength of the pushes to the downside. So you can say there is an impulse to the upside in this marketplace at this moment in time. okay? And basically, this is what this indicator is basically helping you to understand if the market is impulsing to the upside or the market is impulsing to the downside, okay? But then you take it to the next level when you apply a little bit of a more complex formula to calculate the ADX, which if I plot it, is giving you that blue line, which what the blue line does is basically telling you that, knowing what it's the directional movement, either, the winning directional movement at this moment in time it's the green, right? There are other times where the winning directional movement is the red. Well, knowing who is the winner, the green or the red, do we have impulses to the upside versus do we have impulses to the downside or vice versa? So then you calculate the blue line, which in this case is pointing at 15, and that is basically telling you overall what is the measurement of that strength, okay? And the classical use of this particular measurement, okay, if I was to plot a line here at around 25, more or less here, okay, if I was to plot our line around 25, so what this would tell you is that, and again, 25, it's, let me make this thicker so you see that better, but basically 25, it's a little bit of a conservative value. Some more aggressive traders may look at 20, but basically every time the blue line is above 25, okay, so for example at this moment in time, the blue line is above 25, so then you would look at, here you are above 25 right there, right? So you will look at starting on this particular moment in time where the blue line went above 25, you will clearly see that the impulses to the downside are winning, okay? And when you see where the market is at the moment in time is more or less here. So the market has been falling, okay? And the overall strength of the move to the downside and those impulses, not only the impulses, the red color impulses, the down impulses are winning versus the green, but the overall effect is above 25, which is what would be known or understood in a classical way by technical analysts using ADX as a trending market. And because the red is above the green, that would be a confirmed down trend. Okay, this is what this would be telling you. Maybe a bit late to the party in this case, because like most technical indicators, especially the classical ones, there is a lagging effect, okay, and that is something that is part of the equation. Now here, for example, we have the same situation. The line goes from below to above 25, so you could look at the green is above the red now, so we are in a confirmed uptrend. So if I was to look at where is price, so we are here, and at this moment in time you are being told not only the impulses are to the upside, but on top of that, given the overall power of those moves based on the ADX formula, so you are now confirmed to be in an up trend that is strong enough to be expected to continue based on ADX, okay? As you can see, in those two examples, we were a little bit late to the party, and again, this depends on market conditions. Some a bit more conservative traders, they may look at 20, which is another very commonly used value for ADX, and at this moment in time, so basically you will be told here when the blue line crosses the value of 20, you would see as well that the red is above the green. So starting at this moment in time, when you look down and when you look up, okay, so that would be the time where you're being told you're in a downtrend. And again, in this case, it didn't last so much more, but again, this is how most people using ADX would utilize it, okay? So again, just keep that in mind. ADX is normally used with the settings of 14, okay, because it's normalized based on the ATR, and the ATR typically is used as 14. 14 is a classical number in the world of technical analysis because 14 is also half of the cycle of the moon. And even though the market only trades, the equities markets only trade 5 days a week, and therefore 14 does not coincide exactly with a half of a cycle of the moon. I guess that was the inspiration behind many of those technical indicators that use 14 as their standard parameter. Okay, in this case, when using classical indicators, you could certainly play with adjustments, and here you can just go ahead and change the values depending on your wishes. But just keep in mind that many of those indicators work well because they become a self-fulfilling prophecy. So I would say that you may want to think twice when changing those values, because probably the best values is to use the same values everybody uses, so you can benefit from that herd kind of like power when many people are buying or selling at the same time. Okay, cool. Okay, so this is ADX, this is DMI, and again, these are the three values that are plotted by the indicator, and I just showed you a classical application on how to use it. Just to give you a bit more details, because normally now I would show you a way on how to combine with the UFOs, or some sort of a smart way on how to use it. If I was to show you a smart way, the smartest way I could think of, to be honest, is to actually use AutoClimate. Because when using AutoClimate is actually looking at DMI as well, and this is one of the calculations that is happening from behind the scenes. And you will see, for example, when, for example, in this particular case, when you have a thin dot, okay, that's a thin dot. It's blue, but it's thin. And the reason why is because notice how, at that moment in time, the DMI minus is above the DMI plus. Okay, so actually you have an impulse to the downside, and that's why while the directional movement is up, sorry, let me rephrase that. Now the directional movement, I may confuse you with the term directional movement index, which is DMI. The direction of price as an average is going up at the moment in time, so we are in a potential uptrend, if you wish. Since the DMI minus, right? So the directional index minus is pointing is stronger than the plus. The red is above the green, so then the dot is thin, telling you that you may not have all the odds in your favor, because the market is actually impulsing down while the average price movement is going up. The impulses are stronger to the downside than what they are to the upside. Okay, so just keep that in mind. So in other words, I will not get into any application of ADX with any other tools that we use, because if you were to ask for my favorite way to do it, basically I would tell you, look at AutoClimate. Okay, in this particular case, it's a very straightforward answer. But while I'm about to get into the next tool, if you guys have any remaining question or any curiosity or any suggestion, more than happy to listen to you on the chat box, and this will be your time to talk about ADX/DMI, because I am about to move into average true range. Okay, so I'm going to load it while I'm double checking the chat box in case you have a comment or a question. And I'm going to do the same thing I did before. I'm just going to right click, add average true range, click OK. So I got it in the screen, and then I will explain that with more detail in just a moment. Okay, so I don't see any comments or questions, so I guess it's all clear. Remember, when I ask if you have comments or questions, it's always very appreciated if you don't have any questions to just go ahead and type okay, or all good, or something like that, so I know you are okay, and therefore that feedback is greatly appreciated. Cool. So we just added average true range. Okay, so what is the average true range? Well, the name kind of says it all. It's the range. Okay, it's the range, and the range of a candle, okay, is the distance between the high to the low of this candle. Okay, so if you look at the high to the low, that's the range. So the average true range, even if I don't explain it, you would probably expect it to be the average range that those candles provide, right? If you look at a bunch of candles, in this case, by default, it comes with 14. So you look at 14 candles in the past, and if you were to measure the high to the low for those 14 candles, added up and divided by 14, so you end up with the average range per candle. Okay. Now, the one word that may be surprising to you here is that this tool is not called average range. It's called average true range. So why do we call it true? Well, what does that mean, true? Well, true means that, especially when you apply it to equity markets that only trade 6.5 hours a day, so then you have gaps. Okay, and when you have a gap, so the question is, how do you account for the size of the gap? Okay, because the gap, to be honest, is movement. It should count as range, even though it's not part of the range, because technically speaking, the definition of range is high to low. Okay, but the gap is indeed price movement that you don't want to you don't want to miss, right? So the average true range basically is a calculation that is looking at the distance between the high and the low. But if there is a gap and the distance between the prior close to the high, okay, happens to be greater than the range itself, or the prior close to the low happens to be greater than the range itself, then the value used for the calculation would be that greater value that includes the gap. And then you average it times 14 candles in this case, because the basic or standard default parameter is 14, even though you can change it, obviously. You can change it to anything you want. So then you would average it, and you end up with these values that we can see on the screen here. In this case, 6.6332 is the current value for the ATR for the SPY ETF on a daily time frame, which means that as an average, including gaps, in the last 14 days, the average movement of that ETF in this case has been $6.63 per candle, which is per day because it's a daily time frame. If you change it to the 5-minute time frame, for example, so now you're going to get an intraday ATR, which is 37 cents per candle every 5 minutes. Again, taking this as an average for the last 14 candles. Okay. So now that we know what is ATR and how it looks like, okay, obviously you can see how volatility changes through time. Another way to say ATR is volatility. When the market is volatile, it moves at a rate of $6.63. When the market is less volatile, so you can see at that moment in time, the market was going kind of sideways, pretty quiet. It was not big candles like here, okay? So then the average true range was more into 3.5 or 3 point something, much less, like half of the volatility, okay? Half of the speed of movement. So again, there are times where the markets are moving faster. There are times where the markets are moving more slowly. I guess we know that. And you can see that, one of the things that you could do with the ADR is kind of identify cycles of volatility that, if you are looking to trade when markets are volatile only, so that could be very useful. For example, you look at it intraday, right? So if I look at, let's say, for example, a 10-minute time frame of the SPY, right? And I was to zoom in, I would need to load more data here. So let me load more data so you can see this very clearly. Like 5,000 candles, for example. It's going to take a while to load, but we'll have it in a moment. And you will see how in a market which is very clear as the S&P, so the cycles of volatility are very, very, very clear. There are clear times, okay? Like, when the market, it's, it's kind of like right after lunch, okay? So there's not too much energy, where there is a moment in time now, where right at the open, 9, 10 a.m., where there is plenty of volatility. And every day, there is plenty of volatility at that time, but also sometimes into the close, okay? There is some extra volatility, and definitely next day into the open. So again, this could also be applied to futures or any other market, and often it could be used to identify cycles of volatility, which is a very basic application of ATR. Another basic application of ATR is to kind of understand how volatile or not a market is from a natural point of view. So, for example, if you were to look at 663, or kind of 8 is the maximum, and kind of like 2.5 is like the minimum. So maybe you pick, like, you assume that, okay, let's say around 5 is the average volatility of the market. And based on that average volatility of this market, you may decide that when you take a trade, maybe let's say you use stops, and then you decide your stop to be at a certain distance, or a target to be at a certain distance in ATR multiples. So again, this could make sense, okay, depending on the market that you trade, and what is your style on how to set stops. So again, understanding the volatility, another application of understanding the volatility of your market, okay? Now, in both of the cases I showed you, while what I said, I guess, makes a lot of sense, it's quite imprecise, isn't it? So one way to make it a bit more precise or less subjective, when you go back to the parameters of ATR, is that you could actually display something much more useful, which is what we call the percentage bands of the range. And you can look back a collection of candles. Okay, so let's say you want to look at this for a 1 year of time. 252 trading days is one full year, and you may want to look at what is the a very high volatility, let's say 90% of the maximum volatility, and what is a very low volatility, maybe 10%. Okay, so if I was to do that and I click apply, so now it's telling you that 90% of volatility in the whole year is 7.49, and 10% of the volatility of the whole year is 3.01. So that could be an application for you to understand what is very low volatile, what is very volatile, so you understand better the market condition in which you are. Maybe what you were doing is you were looking at 50%. I'm just going to go for 50% both, so we only have one line. And now you know that 5.25 is the exact 50% of the volatility range in the last 1 year. And that may be useful to you in the sense that, as I said before, when looking at setting stops, for example, if you are looking for a static value of ATR that doesn't change too often throughout the year, so you may say 525 is my value. Every time I take a trade, I will consider the market has moved too much against me if the market moves $5.25 against me. Why? Because that's the average value for the ATR for the last whole year, and that you may define that as a normal movement on that market. So if you have a full normal movement on that market against you, you may decide you want to get out. Okay, again, just giving you alternatives on how to personally, if you have been watching, and many of you I know you do, you've been watching the live trading sessions, so you know I don't do this, but there are many traders out there in the world that use ATR as a way to set stops. And the problem is that ATR fluctuates a lot, so now you have an objective way on how to have a static value of ATR that will typically last for a long time. Okay, you can see here how since June all the way to almost October, the ATR value you would have used for stops was the same. Okay, so that's the beauty of doing that. And finally, another way to utilize this, okay, is to utilize this. Again, I'm going for extremes, 90%, 10%. Okay, so if I click OK, so now you know what is a very high value of ATR, what is a very low value of ATR, right? And if I was to compress this and add more data on the screen, okay, so notice that there are times where the markets become extremely volatile, and there are times where the markets are extremely quiet, right? So when the markets are extremely volatile or extremely quiet, this opens the door for certain opportunities. Okay, so for example, the market now is crazy volatile. Okay, that took place at this moment in time. Okay, that was the time. Okay, so then you could have set this up as a way to set a target, for example, and get out because you may believe the market is not going to be sustainable in that direction because it's too volatile, or even initiate some sort of a counter trend trade. Okay, this could be the case as well. Okay, or maybe if you are looking for low volatility conditions, expecting the market to then accelerate. So, for example, here, again, just picking an example where you are below the bottom line. So you can see here how the market is relatively quiet, right? So you may be expecting the market to pick up direction. So let's say you find an opportunity like that, and let's say options are very cheap. Maybe you go ahead and buy a long straddle, for example, which is a non-directional strategy where you buy a call, you buy a put, and now if the market goes down or up in both directions, you're going to profit. So if you were lucky enough, because it's not going to happen too often, but if you were lucky enough to find very cheap calls, very cheap puts, and you could buy a straddle when the market is very compressed. Okay, some traders out there in the world talk about the markets from the point of view of a squeeze and then an explosion, an expansion. So this is kind of like a squeeze that would typically be followed by an increase of volatility, because technically speaking, volatility now is in the bottom 10%. Okay, so market is really not volatile, and therefore we are supposed to see an increase of volatility when you don't know the direction, unless you overlay AutoUFOs into this equation, and now you have something a bit more interesting instead of simply to know the market. It's over relaxed. But yeah, again, this would be the concept, okay, that I wanted to mention on how you can use it. Okay, so for example, at this moment in time, let me go back here. So rewind. So at this moment in time, okay, so the market is next candle. Yeah, so the market is now very, very compressed. Okay, so if you had a green or a red UFO, which unfortunately, okay, now there is one. So the market is very, very compressed. So if the market that is very compressed is very non-volatile, the market was to go back to the red UFO, which it did. So now you can bet on a trade where volatility will increase. Okay, and it did. Okay, of course, like all trades, is not always going to work, but it's a way to increase the odds of reaching your target quicker. If the market is less volatile and is about to become more volatile, so the odds of reaching your target quicker are greater. Okay. Yeah. What's the downside of doing this? Well, the downside is that probably you will have less opportunities to trade if this is one condition for you to trade, that the market needs to be very, very much compressed and volatility to be so low. So then, I guess you will find much less trades compared to another trader who is looking at trading in conditions where volatility is, in a normal range instead of so compressed. Okay, but again, it has its advantages as well, and therefore, here was my mini lecture on ATR, and at the same time, now you know how to insert ATR in the platform and how to utilize it. Okay, so again, please feel free to comment on the chat box if there is any question, any comment, if you liked it, you didn't like it, or if it's all okay. So please go ahead and type all okay. In the meantime, I will do some cleaning on my screen and I will take a sip of water. So I'm ready for the next one. Okay, so it seems that all is good. Perfect. So let's take a look at study, and let's talk about the next one now. Okay, and the next one that we're gonna discuss, okay, at this moment in time is, yeah, thank you for that, Mark. Very appreciated. Very nice. So the next one we're gonna talk about now that we know about ATR is the Chaikin money flow. Okay, but I cannot talk about this one unless I talk about MACD as well. Okay, and to be honest, they are very different, but at the same time, they're not. Okay, so let me start with MACD, then I'll come back to the Chaikin money flow, and then you'll see why I talked about MACD first. So let's add MACD, okay? And before I explain any of this, I'm just gonna add it and click OK, so we have it on the screen. And then I will explain what this is, okay? Okay, so MACD is a study that shows in the subgraph. Most of the studies that show in a subgraph are known as oscillators, but MACD is not an oscillator. MACD is a trend following type of indicator, or a trend indicator, if you wish. You may use it for trend following, or you can even use it for counter trend trading, but it's not an oscillator. Okay, it is not an oscillator that oscillates between up and down between the zero line and tells you about overbought and oversold conditions. That's what oscillators do. What MACD does, it's tell you about the trend. It's, a totally different story, but if I plot a moving average, which is an indicator that shows as an overlay on the chart, for example, the 20 moving average, this could be seen and could be used, and indeed is used by many people out there, as a trend indicator as well. It's a moving average, okay? Well, the difference between the moving average and the MACD, apart from how it's calculated, is the fact that the MACD is in a bottom subgraph. So many people will think of it as an oscillator. I want to make sure you understand it's not. So what is MACD doing? Okay, well, the first thing that MACD is doing, it's calculating the 12 and the 26 exponential moving averages. Okay, so if I go ahead and I input moving average 12 exponential, and then I add another study and I add another average, and it's moving average 26 exponential, and I click OK. So now I have two moving averages. Okay, now I have two moving averages, and the distance between them which could be positive or negative, depending if the 12 is above or the 26 is below. Okay, so let me go ahead and change color. So edit study for the 12. I'm going to make the 12 to be magenta, for example. Okay, so when the market is going higher, the 12 is above and the black is below. When the market is going lower, then the one that is magenta goes below and the black is above, right? Because the 12 is faster than the 26. So if the market picks direction in one direction, so then the colored one will accelerate and surpass the black average. So what the first thing MACD does is to calculate the difference between those averages, because what happens is that if the market is going up, but it's not too much, so then the distance between the averages is going to be small. But when the market really picks up speed in that direction, so what's going to happen is that those averages are going to be further apart. Just like when the market comes back down towards the average, then those averages are going to come back closer. And if the market not only goes down, but actually continues going down, so then you'll have a crossover and there will be an inversion on the location of those moving averages. So in other words, when you calculate the distance between averages, which is, which is the blue line, okay, on MACD. So when you calculate the distance between them, so you would know, where you're at, okay? And also when there is a crossover, when the moving averages crossover, so because the blue line now becomes negative because the distance between the averages is negative, so now you would find yourself below the zero line. So when the blue line is below the zero line, or when the blue line is above the zero line, these would coincide, with those crossovers. Okay, crossover to the downside, crossover to the upside. That's what MACD is doing. Okay, now the other thing that MACD is doing, apart from calculating the distance between the moving averages, it's to add what's called a signal line, which is a 9 moving average of the blue line. So you have an average of the difference between averages. Okay, so there is a lot of lagging in here, but at the same time, there is also a lot of confirmation because it's average on top of average. Okay, so what happens that if the blue line in MACD goes above the average, so not only it means that this tool, okay, this average is, likely going to pick up speed to the upside and potentially crossover. On top of that, it's telling you that the average of the difference between averages, hopefully I'm not driving you crazy, it's also changing its trend. So in other words, there is a lot of energy picking up in that particular direction, which is the beauty of averages on top of averages, because you got plenty of confirmation, as I was saying. Of course, the downside is that when you finally get all of those confirmations, it may be very late. So for example, this crossover here is taking place when the market is already here, okay, where the bottom took place here. So you have a little bit of a lagging effect, but notice how the crossover is actually happening a bit sooner compared to when the blue line crosses zero. Okay, so this is one of the reasons to use the 9 EMA on the MACD line, because while it's an average on top of an average, which could have a lagging effect, actually you could identify potentially, not always, but you could identify a crossover before it happens, which is then likely going to last because you have average of an average, in your favor, and that means a lot of energy in your favor. So that's what MACD does. Okay, and then just to make it more fun, then you calculate the difference, just like the MACD line is the difference between the averages on the top of the screen. So now you got the differences between those two averages on the bottom part of the screen, which is the MACD line and its own average. And then the difference between those, it's plotted as a histogram. Okay, so notice when that guy crosses over, this is 0. Okay, now the blue line is going down, so the histogram is going down. Okay, Now, for example, a clear example, for example, here. So you got a crossover, so it's 0. Now the blue line is going above the magenta line, so now the histogram is going above 0. Okay, so the distance between averages below is seen as the histogram. Okay, so this could be used in many different ways. Okay, now that you know what this is, and again, this was a crash course on MACD. If you didn't know what's MACD, probably this is way too fast, and you may need to review this recording a few times. But if you knew what it was, hopefully that was a good summary. Or even if you didn't know what it was, at least it gets you understanding what this tool does. And if you're interested, you can always research more on it. But basically now, when it comes to how to use it, so one of the classical applications is as a trend technique, where every time the MACD, the two lines of the MACD are above 0, you would call this an uptrend. And every time the two lines go below 0, you would call this a downtrend. So in other words, the two lines below 0 started from here. So starting from here, you would call it a downtrend. And the two lines go above 0 started from here. So starting from here, you would call this an uptrend. And all this time in between, well, that would be problematic trading time. But from here, now you're in an uptrend, potentially going to make money to the upside based on MACD. All this time, both lines remain above 0. So all this time, you would call this an uptrend. Okay, and all this time, the two lines are below 0, and therefore you would call this a downtrend. Those are classical applications. Again, I guess you are with me that tools such as AutoClimate would probably do a better job than this. But again, I'm just describing how this is being used by many fund managers. Other fund managers are defining the trend based on the histogram. So again, when the histogram is below, you would call this a downtrend. When the histogram is above, you would call this an uptrend. But now you get plenty of choppiness where, you got so many changes of trend nonstop, which don't make it as smooth, if you wish, as a trading experience compared to using the MACD lines as a trend indication. Okay, what is another application of MACD? Well, another application of MACD, which is commonly used with oscillators, and again, MACD is not an oscillator, but this application is the same, is quite common. It's to look at convergences or divergences. Okay, so what is a convergent and what is a divergent? Okay, so for example, at this moment in time, we have a convergence. If you look at this low, this coincides with this bottom histogram. Okay, and if you look at the next low, is right here. Okay, and this coincides with this bottom part of the histogram. Okay, so what do you see? Well, this is a low, and this is a higher low. And what do we see above? So this is a low, and this is a higher low. So in other words, whatever calculation is applied by MACD, which now you know, somehow that calculation is picking up strength to the upside as an average of an average, right? Well, that strength to the upside, which is being picked up by the math, is also being seen by the price action itself. So there is a confirmation that the price action and its built-in energy, if I can phrase it this way, are actually converging. They are in line, they are correlated, and therefore there is no risk perceived. There is no perceived risk for the market to do something strange and suddenly change direction. It seems that the energy built in the market and the market movement is in line. Okay, so this is a convergence. Okay, now what about a divergence, for example? Well, and here, for example, we have another convergence, right? So lower low, higher low. Okay, and here lower low and higher low. So that's another convergence. So that's okay. Okay, but what about a divergence? Okay, so let me find one. One that is clear. Okay, so here we have one which is very clear, and by the way, that one failed, but it's very clear. So you look at this peak, and it coincides with that peak. You look at this peak, and it coincides with that peak. Okay, and they are equal high where this is higher highs. Okay, so this is what would be known as a divergence. Okay, and you would expect the market from there to fall. That's what you would expect, which it didn't happen. Okay, and again, of course, probably you load the UFOs and there were no UFOs, and that's why. But putting that on the side, many market analysts, they would look at this and they would be like, okay, so this market is giving us price action to the upside with higher highs, but the energy built in the price movement is actually showing, you know, a neutral type of component. Is not showing higher highs as well. It's actually showing a divergence. Okay, and it doesn't need to be showing, lower highs. That would actually identify even less strength. But just being flat while the market is making all-time high or higher highs, well, in that particular case, would be showing weakness. And many market analysts would expect a change of trend, either a correction or a new trend to develop to the downside, whatever. But they would expect that to happen. Even though it didn't happen in this particular case. Okay, let me take a look at the next one here, because here we have another one. Yeah, another one that fell. And by the way, those that fell typically is because they are against the trend. Okay, and this is the thing when you are dealing with a market which is very powerful. No matter the divergences and the convergences, typically you're gonna end up in trouble. Because you are fighting the trend. So you gotta be aware of that. But let me try to find an example at least so you know how it looks like in a textbook. Okay, which again, trading is beyond textbook. But here we got a textbook example where this high is right here, and the next high is right here. Okay, and this is kind of like equal highs, where this one is lower. Sorry, not like that. Okay, that was terrible drawing. Here we go. Lower highs, right? So you have lower highs while above you have flat highs. So again, this is a divergence, and you would expect a change of trend, which in this case, to be honest, is not a change of trend; it's a continuation of the trend to the downside, because it was coming from a downtrend. All this time, MACD was below the zero line. So if you speak the MACD language, that was a downtrend. And therefore that was just a continuation of a move. But you would have expected this to work well because of that. Okay. Now, the way to utilize that more efficiently maybe would be, again, just giving you ideas. That's why I said maybe, because everybody has their own trading plans. But notice how here you have UFOs. Okay. So now price comes to the UFO. Okay. So there was a UFO there. So price comes in. So you can see how as price is coming in the UFO, there is a divergence. Okay, and here we go. So now you have the move. So this could be a way on how to take advantage of it, and that's why I'm mentioning this to you. Okay, cool. So actually, let me remove all studies on the upper part. Okay, so this is MACD. Okay, and if I was to insert MACD one more time, so you have multiple settings that you could play with. 12 and 26, that's standard. Source is the close, that's standard. And then the smoothing for the MACD signal is also standard. Then you can either hide or display the histogram depending on what your use. So maybe you are not looking at divergences and convergences, and therefore you don't care about the histogram. So you just leave it like that. And when you are above the zero line, this is the zero line. So when you are above the zero line, it's an uptrend. When you are below the zero line, it's a downtrend. So downtrend, downtrend, everything else is uptrend right here. So again, that's one application. Okay, maybe you want to display the histogram, but you don't want to display the MACD lines because you are actually only looking for divergences or convergences. That's all you look for. So then that would be the way to do it. If you want to look at everything, which is what most MACD traders would probably do, that's how you do it. That's how it looks by default in most trading platforms. Okay. Something unique off top, but again, not sure I would recommend it, is that you can also calculate MACD based on different calculations. For example, high, low, and close divided by 3. But again, the beauty of those technical indicators, as I said before, is that typically they work powerfully because many people use them. So if you end up changing the settings, you happen to be the only one using MACD the way you use it, and not sure it's going to create a self-fulfilling prophecy effect. So do your back test, think about it, and you decide what's best for you based on your trading plan and your rules, obviously. But I mean, I guess you got my point, right? Anyway, so now that we know what's MACD, we need to talk about the last tool, which is the Chaikin money flow. And you will see why we talked about MACD before. Before I do that, I would like to get your feedback on MACD. How did it go? Everybody follows with MACD, everybody with me. Any questions? Let me know. I'll take a sip of water and we will continue. Thank you for that. Yeah, Mark, I see your comment. Definitely, I mean, MACD has indeed many followers, especially traders coming from the world of technical analysis that have been trained intensively on technical analysis. They may really like MACD, and it's a smart tool. It's indeed a smart tool. And again, one more time, because so many people use it, especially in the world of market analysis, fund managers, and so on. So it may have a very powerful effect. I remember, not sure if I have enough data loaded here to. No way. I think we need to load way more data. Let me see. Or maybe I have enough data. Yes, correct. So this is the crash in 2008, right? And when you see the crash in 2008, so there were many people saying at the time that there was this positive divergence in MACD, where the market was making lower lows, but MACD was making higher highs. So many people started buying, somewhere, let's call it here. Now, probably they were scared a bit more for a little longer. But then finally, to be honest, that's when now the new bull market started. So again, it could certainly reveal something coming, but it could also kind of get you off timing for a while. Because again, it's a very lagging indicator, so it has the beauty of giving you a lot of confirmation, but also it's lagging so much that being off timing, unless you use other tools on top of it, such as the UFOs, it's quite probable. Okay, so again, like everything in life, everything got pros and cons. Okay. Anyway, so let's remove MACD, and now let's discuss our last component for the day, which is the Chaikin money flow. And I'm just going to add it to the screen. It comes with 21 as a default. So I'm just going to click OK. And if you look at this tool, it really looks like the MACD histogram, maybe a bit slower. So if I re-add MACD, right, and I click OK. So notice how you have here one bottom, a second bottom. Here you only have one bottom. Okay. Here you have one bottom, two bottoms. Here you have only one bottom. So it's kind of looking a little bit slower. And of course, it's using 21 instead of 14. So it has to look a little slower. But what's interesting of this tool, what's very interesting of this tool compared to MACD is that this tool is not only made of price action. MACD starts with the calculation of the distance between the 12 and the 26 exponential moving average. So it's all about price action, open, high, low, and close, whatever is on the candle, wherever you see on the chart, wherever the candle tells you, that's where the MACD calculation comes from. But it's not the case with the Chaikin money flow. Do you guys remember in a prior session when we talked about accumulation distribution? And when I talked about this, I linked it to the unbalanced volume, which is the price times the volume. And if the difference between yesterday and today's close is above or below, then the calculation is either plus or minus. Well, and do you remember that when we looked at accumulation distribution, it was a bit more complex? It was not only looking at the close of the prior day versus the close of today. It was looking at the size of the wicks above and below, and basically it was kind of in a different way, but kind of looking at the directional movement index times the volume, kind of, okay? Well, that accumulation distribution calculation, it's what is being used for the Chaikin money index. And therefore, the Chaikin money index is doing the same thing as MACD, looking at the 12 and the 26 moving average, but instead of being applied to the price, is actually applied to the accumulation distribution formula. So in other words, you are looking at an sophisticated formula that utilizes price and volume, and that sophisticated formula is then treated like MACD would treat price. But in this case, it's not price, it's price times volume in a sophisticated fashion. So when you're looking at this, again, looking at signs of strengthening or weakening markets, it's actually theoretically quite powerful. I would say more powerful than MACD. Maybe we can do the exercise to go back to 2008 when we had this major turn in the markets and see the difference of what you saw earlier with MACD with what we would see with this particular tool, okay? And at a moment in time, so you could see here, there was also a low, and that low was also pointing at here. So there was these lower lows, but also higher lows. So there was the same divergence that we saw on MACD is here. And again, it's the calculation is the same, but the beauty here is that you have the volume component in it, and therefore there will be times where those divergences maybe, again, maybe means that used by itself is probably incomplete, but maybe more powerful compared to MACD, given the fact that volume is also part of the formula, and volume, it's typically what helps for a trend to continue. If price movement is happening in a certain direction, but the volume does not accompany that price movement, typically the price movement will either stop or reverse, okay? So here in this particular case, we can see a low. Here in this particular case, we can see another low. There is higher lows and there are higher lows. So it's a clear and neat convergence, okay? Clear and neat convergence. So the market is supposed to remain in that condition. At least this convergence is telling us the price movement in the market is healthy enough for us to expect it to continue the same way. At this moment in time, for example, you had some sort of a high, then you have another high. This was higher highs, this was higher highs, so you would expect the market to continue, okay? But then, at this moment in time, you had a high, and then you had a lower high, okay? And while you had a lower high here below, here you had higher highs, and here you had lower highs, and that would have been a sign to tell you, careful, something may be coming, because volume does not accompany the price action, and we have this lower high instead of a higher high, and here we had a correction, okay? Again, this is not going to happen all the time, but there will be times where these will be identified and it will be useful. For example, in this particular case, you had a high, and then you had kind of an equal high, kind of. This one is, to be honest, difficult to read. In any case, it's kind of an equal high, where here is looking down, like lower high. So you would expect the market to correct, and it didn't. It continued going higher. So again, that's why I said that using these tools by itself is probably an incomplete way on how to trade. Using those tools combined with AutoUFOs and the other tools that we use in the platform, which are all built in the platform, so probably will make you a way better trader. But again, here's a tool for you to evaluate the market conditions with a little bit more depth compared to MACD. And the reason why I'm saying that is because here, apart from price, you also have the volume component built in, while the calculation is exactly the same as MACD, okay? So anyway, so to insert the Chaikin money flow, you just right click to add study, and you just select it from the list. And once you inserted it, you have the parameters, which you can also access by double checking. To be honest, here there is nothing. The only thing you have is the length, which by default is 21. Again, you can certainly change it, but I made my point multiple times that typically the classical settings may end up being more powerful in the sense that more people watch it, and then you can change the color, and you know, little more than that. It's just behave like any other study in top. So with that said, that is all for today, my friends. I'd love to ask you, how was it with the Chaikin money flow? The Chaikin money flow, did it go well? Any final question? And also, Mark, I did not see your screenshot, so I'm guessing that you have sent an email. So I'll take a look at that, and promise, I'll get back to you quickly, because I do owe you some emails. And good news, I'm, tomorrow is Monday. We are back to a normal week, after Santa Claus came and left, and at least here in Asia, Santa Claus left all the way already, and I'll be able to get back to you soon, Mark. Thanks for your patience on that. Don't see any additional comment from you guys, so I will take this as the session went well, that you enjoyed it and you learned a lot. And if that's the case, so then that makes me very happy, and probably it's also good for you. So thank you for joining me, and I will see you again on Wednesday on our live session, everybody. Thank you for joining me today. I always double appreciated when you guys join me on the Sundays, and even more appreciated on a weekend like this weekend with Christmas happening, which is obviously a very big celebration. I just need to uninstall and reinstall top, I think. That certainly could help if you access your Windows settings. You go to programs, and you double click on top. It will give you an option to repair. So that repair option will basically reinstall. But anyway, feel free to connect with me, Mark, directly. Feel free to connect with our support team as well, and we'll give you a hand. No, not an issue. Take care, everybody. See you soon. See you on Wednesday. Bye-bye, everybody.